Hello, everyone. Welcome to the market opening bell on Tuesday, June 3rd. June started on a weak note with markets focusing on US-China trade talks. Hong Kong stocks fell on Monday with the Hang Seng Index opening 246 points lower and dropping as much as 621 points to a low of 22,668. The decline narrowed significantly in the afternoon, closing down 131 points or 0.6% at 23,157. The X-share index fell 72 points or 0.9% to 8,359, and the Hang Seng Tech Index dropped 36 points or 0.7% to 5,134. Total market turnover was 145.2 billion Hong Kong dollars. A-shares were closed for holiday and southbound trading via Stock Connect was suspended. Technical analysis: the Hang Seng Index briefly fell below the 50-day moving average yesterday, but held the line, suggesting a potential rebound from the first breach of the 50-day line. If the 50-day line is ultimately broken, we can use Fibonacci retracement to predict downside targets. The index rose 4,657 points from 19,260 to 23,917. A 38.2% retracement would target 22,138 near the 100-day line. A 50% retracement would hit 21,590, filling the April 23rd gap between 21,593 and 21,863. A 61.8% retracement would target 21,040. Macau's May gaming revenue rose 5% year-on-year, hitting a five-year high, driven by the May Day Golden Week. Casino stocks rallied. Sands China surged 4.3%, while Galaxy Entertainment, Wynn Macau, and SJM Holdings gained 1.8% to 2.5%. The Macau government projects 2025 gaming revenue at 240 billion petas, up 5.8% year-on-year, significantly lower than 2024's 23.9% growth. Cumulative gaming revenue for the first 5 months of 2025 reached 97.7 billion petas, slightly below the 100 billion target for 5 months. Long-term, due to new gaming regulations and economic conditions, Macau's gaming revenue is expected to range between 220 billion and 250 billion petas, struggling to return to the pre-pandemic 300 billion level. The price war in China's auto sector has drawn regulatory attention. A recent People's Daily commentary highlighted that the China Association of Automobile Manufacturers issued a proposal to maintain fair competition and promote healthy industry development, explicitly opposing price wars. The Ministry of Industry and Information Technology supported the proposal, stating that price wars have no winners or future. Auto stocks generally weakened. NIO will announce its earnings today. The price war among delivery platforms also caught regulators' attention. JD.com fell 0.2% and Meituan dropped 1.7%. JD Delivery announced its full-time rider workforce exceeded 100,000 nearly 2 months ahead of schedule and plans to expand to 150,000 riders soon. JD Delivery's daily orders surpassed 25 million, with over 1.5 million quality dining merchants on board. However, JD Delivery's 10 billion subsidy policy is reportedly undergoing adjustments. Several merchants noted that the previous 50-50 subsidy call split between the platform and merchants has shifted to merchants bearing 70% to 80% of costs, with some promotions requiring merchants to fully cover delivery fees and offer lower than usual discounted prices. US President Trump announced plans to double tariffs on imported steel and aluminum, leading to a lower opening for US stocks on Monday, with the Dow Jones Industrial Average falling as much as 416 points. Later reports indicated that the US was seeking optimal negotiation proposals with trade partners by Wednesday, and the White House revealed an upcoming call between US and Chinese leaders, turning markets positive. The Dow closed at 42,305 points, up 35 points or 0.08%. The Nasdaq rose 128 points or 0.7% to 19,242, and S&P 500 gained 24 points or 0.4% to 5,935. The Nasdaq Golden Dragon China Index, reflecting Chinese stocks, rose 0.5% by close, with Alibaba up 0.8%. The potential for higher steel and aluminum tariffs boosted U.S. steel stocks, with Cleveland-Cliffs surging 23.6% and Nucor and Steel Dynamics each rising over 10%. Automakers, however, saw declines, with Ford Motor and General Motors both falling nearly 4%. Among major tech stocks, Nvidia rose 1.7% and Meta gained 3.6%. However, Alphabet fell 1.6% and Tesla dropped 1.1% due to declining monthly sales in Portugal, Denmark, and Sweden. Energy stocks rallied collectively as oil prices rose after OPEC Plus announced that July's production increase would remain in line with the previous 2 months, alleviating fears of a larger output hike. On economic data, two purchasing managers' indexes showed significant divergence. S&P Global's latest survey reported U.S. manufacturing PMI at 52 in May, up from 50.2 in the prior 2 months, indicating robust growth and the best performance since February's recent high, though below the preliminary 52.3. In contrast, the Institute for Supply Management reported May's manufacturing PMI at 48.5, down from 48.7 in April and below market expectations of 49.5, marking a third consecutive month of contraction and the largest decline since November 2024. U.S. construction spending in April fell 0.4% month on month, against market expectations of a 0.3% rise, following a revised 0.8% drop in March. Our stock pick today is Gushengtang, stock code 2273. Gushengtang is primarily engaged in providing various healthcare services and selling healthcare products. As a Chinese traditional medicine (TCM) healthcare service provider, the group builds on traditional TCM diagnostic and treatment methods, integrating them with Western medicine, example clinical examinations and treatments. It offers TCM healthcare solutions, particularly for chronic disease management, through a combined offline and online medical service network. With the rapid development of internet technology, an increasing number of Chinese TCM healthcare providers are integrating offline medical institutions with online platforms to address challenges such as limited customer reach in traditional TCM diagnostics, uneven distribution of physician resources across regions, and difficulties in patient follow-ups and long-term health management. On one hand, the development of online healthcare services enables the group to utilize medical resources more effectively and expand customer coverage. On the other hand, it allows the group to strategically select regions for offline expansion based on online physician and customer activity. As of December 31st, 2024, the group owns and operates 78 medical institutions across Chinese cities, including Beijing, Shanghai, Guangzhou, Shenzhen, Foshan, Zhongshan, Fuzhou, Nanjing, Suzhou, Ningbo, Wuxi, Hangzhou, Zhengzhou, Wenzhou, Kunshan, Wuhan, Changshu, Xuzhou, Changsha, and Jiangyin. It also owns and operates several offline pharmacies for selling healthcare products. Furthermore, the group has expanded its medical service network to overseas markets, such as owning and operating one medical institution in Singapore. The group operates multiple online channels, including its official website, mobile app, WeChat public account, and mini program, and collaborates with several third-party online platforms to facilitate online booking of offline services. For the year ended December 31st, 2024, the group's consolidated revenue was 3.022 billion yuan, a 30.1% increase from 2023, primarily driven by higher revenue from healthcare solutions. Profit attributable to shareholders was 306 million yuan, up 21.6%. Adjusted net profit was 400 million yuan, a 31.4% increase. The overall gross margin was 30.1%, with the gross margin for healthcare solutions remaining stable at 30%, while the gross margin for healthcare product sales rose from 35.2% in 2023 to 36%. According to the group's operational data, for the 3 months ended March 31st, 2025, total patient visits reached approximately 1.21 million, a 12.7% increase from the same period in 2024, approximately 1.074 million visits. In July 2024, the National Administration of Traditional Chinese Medicine and the National Data Bureau jointly issued several opinions on promoting the development of digital Chinese medicine, outlining plans to integrate emerging digital technologies such as big data and artificial intelligence into TCM innovation over the next 3 to 5 years. The policy emphasizes data sharing, AI model development, and the application of digital technologies to accelerate the intelligent transformation of TCM services. The group aims to advance AI applications in medical scenarios, accelerating the development of industry-specific large-scale models and smart healthcare solutions. Recommendation buy at 35.5 Hong Kong dollars with an initial target of $38.5, followed by $40. Stop loss at $34. I do not hold the above stock.